I was asked to share my thoughts about the Silicon Valley Bank situation. I want to convey that it's very indicative of what the whole economy is like.
Hi, JJ here again with the Art of Value. Welcome. Well, as you saw, Ray Dalio's just posted a video about the Silicon Valley Bank collapse and how he thinks it relates to the US economy and the world economy. I'm going to unpack what he says a little bit. This is a short video, but there's a lot in there. So let's get into it.
So there's its particular situation and the Fed coming in and guaranteeing all depositors. But it's a common situation. It exists pervasively. And what is it that I'm talking about? That there has been a lot of creation of debt to make investments. So, for example, banks, insurance companies, they borrow money at a certain rate, and then they go out and they make investments. And when those investments have lower returns, go down in value, as stocks and bonds have gone down in value, or they don't have adequate yields relative to the cost of funding those assets, you have everybody losing money. And that is a pervasive situation that exists throughout the economy, the world economy, the US economy.
What he's talking about, the it there, about people borrowing money to make investments worldwide. He's talking about the world economy and the US economy and relating it to Silicon Valley Bank. So this was the problem with Silicon Valley Bank. I've made several videos about Silicon Valley Bank and what happened. So they bought long-term treasuries and the value of them went down, and they were forced to sell them because the depositors started taking their money out of the bank. They used the depositors' money to make those investments, and they had a huge amount of investments when there was this boom, this bubble, and then they went down and they were forced to sell those at a lower value, and that caused the bank to collapse. And so he's saying that there's a lot of this going on in the world economy. People are borrowing money in order to invest, and the value of those investments are going down. It's not necessarily realized because they haven't had to sell them, but in terms of mark to market, what they're worth right now, we'll talk about this a little bit later, they're worth less. And so this is a pervasive problem throughout institutions in the world. I think that's what he's saying.
In other words, the world is long, so long holding assets that they're betting go up, and they're leverage long, meaning that they have borrowed money to hold those positions. And so that set of circumstance, as we've been talking about, has put the Federal Reserve and our country in a situation where it's very difficult to create an interest rate that is high enough to provide a real return. In other words, a return after inflation that is high enough to compensate you for holding that asset, to provide that interest rate that's high enough at the same time as not damaging those who have borrowed that money. That balancing act is difficult.
So further, what he's saying there, the world is long and it's leveraged long, meaning long that you're betting that the assets that you've bought are going to go up, but leveraged long means you've borrowed the money to, and in the hope that those assets will go up, we're betting that those assets will go up. So that's a precarious kind of situation. He says a difficult situation when too many people, too many institutions, and like Silicon Valley Bank, when you mark to market the assets, or you have to sell those assets, you're going to lose a lot of money.
And there's this big supply demand means that there's a need to borrow a lot of money. If you look ahead and you say how much money needs to be borrowed by the Federal Reserve, by the government, in order to deal with this situation, big deficits, that means they have to sell debt. There's a supply-demand imbalance. In other words, those who want to buy debt, what are they going to buy it for? They need to have a high enough real return. If they don't have a high enough real return, they can sell the debt, or their debt that they're holding, rather than buying that debt. And that creates a terrible imbalance. And so that imbalance is the nature of what's going on. So and they're not marked to market, a lot of these. If you mark to market, a lot of entities are in financial difficulty.
So there at the end, he talks about this massive imbalance and the mark-to-market situation, the difficulty. So if you're not sure what mark-to-market is, this is a definition from Investopedia, good website for finding out financial terms, what they mean. Mark-to-market is a method of measuring the fair value of accounts that can fluctuate over time, such as assets and liabilities. Mark-to-market aims to provide a realistic appraisal of an institution or company's current financial situation based on current market conditions. In trading and investing, certain securities such as futures and mutual funds are also marked to market to show the current market value of these investments. So again, this is what happened with Silicon Valley Bank. Their mark to market value of the treasuries that they held was much lower than what they bought them for, and they were forced to sell them. And I think that is really what Ray Dalio is saying here, that throughout the world and the US economy, there are a lot of, he says, there are a lot of institutions and entities, he said, in this situation. So if at any time they are forced to sell more, there could be more mayhem unfolding. I think he doesn't come out and say that, but I think that is the risk. And specifically again through Investopedia, what are mark-to-market losses, which we're talking about? Mark-to-market losses are losses generated through an accounting entry rather than the actual sale of a security. Mark-to-market losses can occur when financial instruments held are valued at the current market value. If a security was purchased at a certain price and the market price later fell, the holder would have an unrealized loss, which he's saying that a lot of entities have unrealized losses at this point out there, and possibly getting worse. It goes on, and marking the security down to the new market price would result in a mark-to-market loss. Mark-to-market accounting is part of the concept of fair value accounting, which attempts to give investors more transparent and relevant information. So Silicon Valley Bank was forced to sell, and their mark-to-market price was a lot less. Chances are they wouldn't have got into big trouble if they hadn't had to sell those securities when they did. It's just that there was kind of a run on the bank. The depositors lost confidence. All of a sudden, over $40 billion was withdrawn in deposits in one day. But that didn't happen all of a sudden. It did happen over time, and enough was withdrawn where the bank had to sell those securities and mark to market at a much lower price, and then they got into financial trouble. And Ray Dalio was saying that there are a lot of institutions in that similar situation around the world. So he's obviously concerned about what might happen. If you've got value out of this video and you've got this far, maybe perhaps subscribing if you're not already, on YouTube, on Spotify video, on Rumble, or on your favorite podcast app. And I'll see you next time. Thanks for listening or watching.